Hello and welcome to another Daily Source of Insights powered by Container xChange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. On Monday, we talked about macroeconomic indicators that are moving this week and have an impact on your decision making. Today, on Wednesday, we typically look at some trading indicators and current market prices to give you a little bit more guidance of what the week is doing. Let me quickly share my screen, tell you what I'm talking about. Let's start with container prices. Looking here at 40-foot high cube cargo worthy in key locations around the world. What you see clearly, the orange line here on the left-hand side is Shanghai. The other lines are that are bunched together are sort of European and US locations. And you clearly see that continuously the diverging price trend with Shanghai and with it other key China base ports are diverging from the rest of the pack. Last week, we already talked about it at Intermodal. There was very, very big discussions around container prices. A lot of traders, a lot of other container owners withholding inventory in the hope of higher prices. And so far, this gamble seems to be paying off. Last week ended with prices for 40-foot high cube cargo worthy boxes around $350 US roundabout. This has increased to 3,500, sometimes 3,600 US dollars in some locations and for some age groups. So prices continue to increase. And of course, this also has an impact, and I'm switching here tabs on the leasing market. These are now one-way leasing rates from Shanghai to specifically US locations, US and Canada locations. And you see here also a little bit more volatility, of course, but prices continue to increase. And that's, of course, because the container price divergence is taking place, and container traders want to capitalize on that. Why is this the case? Well, containers are in short supply right now, specifically in China, because of still the impact of the Red Sea diversions, and with it the unreliability of liner services, and with that the congestion in key ports around the world. We've just read headlines around Singapore and liners skipping the port calls in Singapore due to congestion. So essentially the waiting time to berth has increased so much that carriers are now willing to skip these ports. And that, of course, will have a downstream impact on other ports that are sort of next in line, because these will then have to pick up the additional volume from Singapore, which in turn will then also lead to congestion in these ports. So that's, of course, the underlying reason here. We'll see how that continues to develop, and how much of the current price increases is due to a little bit of a bubble panic because of short supply, or sometimes artificially short supply. But that will time will tell. That's it from us for this Wednesday. Take care and see you all on Friday, I hope. Take care.